Hey, how's it going, everyone? This will be an in-depth video about Cisco, the tech company that is trading near their 52-week low. So the current trading price is about $45, $46 a share. The low was $44.97. So I'm trying to figure out, is it a good time or a bad time to jump in right now? Which is crazy to think about because during the dot-com bubble crash about 25 years ago, Cisco was considered one of the best companies available on the stock market. And back then, they used to trade for about $65, $77 a share. And since then, my goodness, it's just been a recovery. And full disclosure, Cisco is a company that may or may not have previously offered me a job to join them as a middle manager. So from preparing for the interviews and networking with current Cisco employees, this is a company that I know a little about. So in this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or a disgusting dividend stock. And just a heads up, the bulk of this video will be focused and centered around the investing thesis, which will be later on. And just a fair warning, this video will be very thorough in its analysis. So you're either going to walk away from the video feeling very happy about Cisco or scared of its future. First, let's go ahead and check out their dividend profile and free cash flow over the years. Cisco's current dividend yield is sitting at about 3.5%, which is respectable. And for the past 3 years, they have been growing the dividend payout by a rate of 2.7%, which means when you look at this number of $1.60, it's going to grow by 2.7% on average based on their historical forecast. And the dividend payout ratio is 53%, which means that the dividend is sustainable and it's healthy. And they have been increasing the dividend payout for the past 13 years. So when we take into consideration Cisco's dividend profile, I think it looks good. I think it's above average. It's what we want to see in a company that we're interested in. Next, let's go ahead and take a look at their free cash flow, what you see on the bottom of your screen. I'm so sorry, I should have probably made this left to right, but whatever. In 2009, they had $8.8 billion of free cash flow. And what we want to see is the free cash flow growing in the right direction. So as we fast forward throughout the years to last year of 2023, now they've generated $19 billion in free cash flow, which is an indicator and tells us that this company is just heavy in cash and their business model is very lucrative, very profitable. So far, so good. Next, let's go ahead and take a look at how Cisco performed against the market for the past 10 years. So if we backtrack about 10 years ago, with $10,000 invested into Cisco and into VU, which is the S&P 500 index, and reinvesting those dividends back into the investment, well, for that initial $10,000 investment with Cisco, it would have grown to $22,000. And for VU, the S&P 500, well, it would have been $30,000. So you would have had a 300% rate of return if you would have just invested into VU. When you break that down year over year, well, for Cisco, it looks like your rate of return was 9%, the CAGR, which stands for Compound Annual Growth Rate. And with VU, the S&P 500, well, that's 12.5%. And I do want to call out that Cisco is slightly more volatile than the market. And what I mean by that is during Cisco's best year, in the past 10 years, the stock went up by 45.7%. In contrast, when you look at VU, in their best year, they only went up by 31.3%. On the flip side, although Cisco has a better year when things are good, look at the worst year, right? For Cisco, it was negative 22%. Whereas for VU, the worst year, they only went down by negative 18%. And if you are a visual person, well, here you go. When you look at it on a graph, I think it tells a more compelling story. So the blue is Cisco. The teal is VU, S&P 500. So when I look at Cisco's performance in 2016 to 2017 and even 2018, outperformed the market by a huge margin. And then in 2019, Cisco underperformed the market by, I would say, a lot. And then during the pandemic, wow, Cisco just got demolished. However, in 2021, check this out. That's beautiful. I think that's the 45% that we were talking about earlier. However, that rate of return would be short-lived because in 2022, look what happened to Cisco and the market. And then last year, the market had a recovery rally, whereas Cisco did not. And then as of this year, my goodness, the market is doing okay, yet Cisco is in the negative. So it's a rough year for Cisco. So based on their historical performance, I would label Cisco as okay. It's not the greatest thing in the world, but it's not the worst, right? Getting a 9% rate of return year after year is okay to me. But with that said, because it underperformed the market, as of right now, I would give Cisco a grade of a C. It's average. It's not that good, but it's also not that bad. Had their rate of return been better than VU at like 13% or 14%, then they would have been in the category of being above average and a great investment. The next metric we are going to take into consideration is the shares outstanding. Essentially, we want to figure out if the company is issuing more stocks and diluting the shareholders, or are they buying back shares? When a company buys back their shares, it's a good thing because that means there's less shares outstanding, which means each share that you own has quality over quantity. Let's go ahead and see what's going on with Cisco. So back in 2009, there were roughly 5.8 billion shares outstanding for Cisco. However, throughout the years, they have been buying it back. So that bottom graph that you see that's depicted by those red bars, if there's like a negative 1.35%, like back in 2012, that means they bought back 1% of the shares outstanding, which is a good thing. And it looks like since 2009, for the most part, they have been buying back their shares, except for 2013. And as a potential investor, this is exactly what you want to see. So back in 2009, there were 5.8 billion shares outstanding. Now there is 4 billion shares outstanding. So the shares outstanding, I would give it a green flag. This is a good thing to see. Next, let's go ahead and talk about Cisco's business model and their economic moat if they have one. And by the way, I do want to call out that these slides are not going to line up with what I'm talking about. However, you can take a look at the slides as a reference to what I thought were callouts or highlights as I was doing my research and homework on Cisco. Speaking of which, what you see on your screen right now was their revenue breakdown for last year. And if I had to sum it up, I would say that Cisco is in the business of enterprise networking and cybersecurity. But I would even argue that they're much more than that. Their infrastructure, software, and portfolio has a contract with a lot of companies in the US. Essentially, any company that utilizes the internet is most likely a client with Cisco or a prior client. So when we think about Cisco's reach and customer base, it's gigantic, and it does not matter if the company is big or small. More often than not, they will be using Cisco's services. And if you know anything about major corporations, they hate change, and change is rolled out very slowly. I used to be a consultant, and let me tell you, there's a lot of pushback from the directors and vice presidents about implementing change. Change is a scary world in corporate America. So if the company is utilizing Cisco, they most likely will not move to another provider, because to make a switch to a competitor is a huge hassle. I mean, think about it, right? It'll lead to a network outage while they transition. There's going to be bugs left and right for the first weeks of implementation to their competitor or an alternative. And Cisco's sales teams usually do whatever it takes to secure a renewal contract with an existing client. And what you see on your screen right now was their most recent quarter's performance. And do you remember how earlier networking was about 50% of their revenue? Well, now look at the numbers broken down. Their networking line of business brought in about $6.5 billion for the past 90 days. Their security line of business was $1.3 billion. Collaboration about $980 million. Observability was $211 million. Service was $3.6 billion. Keep this one in mind because we're going to circle back to it. So when I think about Cisco, I would say that they have an economic moat on the basis that customers would not want to switch to another provider once they have been with Cisco. Because if the company's data and networks are all serviced through Cisco, then changing providers will be a nightmare of a situation. But when I think about tech-savvy companies that are agile and small, they're probably going to jump ship and try out the new startups as an alternative to Cisco if they get better pricing, or if the contract deal is better, or if the product is just better than Cisco's. So with that said, the old blue chip companies with like 50,000 employees, when I think about like Procter & Gamble and Colgate-Palmolive, when I think about those companies, they are more than likely going to stay with what they're comfortable with, which is Cisco. As a former director in corporate America, I can testify that in the business world, there's a saying, if it ain't broken, then don't fix it. Leave it be. If you have ever worked at a big company before, then you know change is slow or non-existent. There is so much red tape, meetings, and signatures required to get anything done. So to sum it up, they secure contracts and licensing fees from companies throughout the world for cybersecurity, networking, firewall protection, and other communication-based services. And their economic moat is that it is a burden for a company to switch companies, so they just stick with Cisco. And for what it's worth, both of the S&P 500 companies that were Fortune 20 that I worked for, all of our networks and computers were actually serviced by Cisco. And by the way, what you see on your screen right now is the revenue trend for the past 3 years, and I guess for this year. And this is depicted in billions, by the way. In 2021, they generated $49.8 billion in revenue. The light blue shade depicts their product revenue, and the service revenue is depicted by the navy blue. And Cisco was headed towards the right direction. However, as of this year, their guidance to wrap up the year is $53.7 billion, which, if you look at last year of $57 billion, that's a decrease. So that's one of the many reasons as to why Cisco is selling off. But with that said, take a look at their operating margin. My goodness, this is a very profitable company. For a company's product or service to be at 64%, 63% margin, beautiful. And for the longest time, their business model was campus focused with literal physical telephones and routers, data centers, and whatnot. However, Cisco have made the upgrade and pivot to being more software focused with an emphasis on utilizing the cloud. Now, since Cisco is an old school tech company, their profit margins are some of the best in the industry because they have tremendous pricing power. As we just learned, they know most companies are not going to go through the hoops and loops to switch providers. So they have the upper hand in most negotiations. But what about growth? Is Cisco growing at all? Well, to help expedite the growth process of their company, Cisco acquired Splunk for about $28 billion not too long ago, I think a few months ago, which helped their bottom line grow inorganically, and maybe that's the route they need to take. Make strategic acquisitions of younger tech companies to make Cisco more attractive and future-proof. And that's the thing people don't realize. Throughout Cisco's company history, they have been the kings of the mergers and acquisitions game. They buy out their competition early on before they pose too much of a threat. And when we look at Cisco's M&A history, I'm talking about hundreds of companies that have been swallowed up by Cisco. The most recent winners were Acacia Comms, Thousand Eyes, Meraki, and Splunk. And the reason why I think it's worth calling that out is because not every company is smart with their mergers and acquisitions. Sometimes a company swallows up or buys another company only to realize that it was a dumpster fire in the inside. However, on the outside, it probably looked like a good deal. But when it comes to Cisco, they have a proven and a good track record of their M&A. But anyways, expanding on Splunk, let me tell you, the integration of Splunk was so freaking smart on Cisco's part because their core business has been struggling with slowing growth, and Cisco had more cash on hand than they knew what to do with. So I think it made a lot of sense. And besides, you can only raise the dividend by so much before it becomes unsustainable for the future or a path towards dividend cuts. So they bought Splunk, which makes a ton of sense. Splunk adds so many upgrades to their portfolio of cyber and data analysis capabilities. And if you're wondering what Splunk does, take a look at your screen right now. The best way that I can describe it is it's a platform that allows you to analyze data, primarily for cybersecurity reasons, but it can also be utilized to monitor and audit whatever you want on the IT network. And something else that I want to highlight about Cisco is that the company and the leadership is very shareholder oriented, meaning they prioritize the shareholders. This past year, they dedicated half of their cash flow to dividends and share buybacks, which if you are a long-term investor like me, it's a good thing to hear and a good thing to see. A company that prioritizes the shareholders means it will do whatever is in its power to grow in all metrics, such as profitability and margins and top line, so that the stock price can grow year over year. When a company does not focus on the shareholders, that's a sign that you should not invest in them. I mean, why would you trust them with your money? Because for me, it's like, if I am not going to be taken care of, why should I park my cash into your company's stock? Fortunately, this is not the case with Cisco. And something else that Cisco has going for them is that they have an educational ecosystem called the Cisco Networking Academy. It's what you see on your screen right now. Cisco has created a training pipeline that certifies people to work on Cisco equipment and software. Think of it as like a Lean Six Sigma yellow belt or a green belt, black belt, those types of certifications that tells employers and gives you credibility that you know what you're doing. These Cisco IT certs are industry standard to show competence, that you understand networking, switches, and all things internet security related. Now, to repeat myself, I am not an IT guy. However, I think this is a phenomenal and a wonderful thing to see, to give people the education and certifications so that when they interview for an IT position, it gives them that credibility, especially if they're making a pivot or if they're trying to improve their quality of life by getting these certifications. And I think this is amazing. However, I don't want to only highlight the positives for Cisco. So let's go ahead and talk about the cynical considerations. And what you will be seeing on your screen right now will be highlights from their investor day that they hosted just a couple weeks ago. And they do it annually. And I promise I'll circle back and talk about what you see on the screen. And here's an unpopular opinion from my research. Some IT engineers and network people believe that every Cisco product is not as good as the competitors. I mean, I'm not an IT guy, so I always thought Cisco software was okay. However, the subject matter experts think Cisco could do better. And that's why Cisco's story reminds me of Intel so much. Both companies used to innovate and be world class, and now they're both inferior. It's like somewhere along the line, they got lazy with making disruptive technology, and instead, they just played it safe. It's such a common thing to happen in corporate America, to play it safe. And while playing it safe, it gave their opposition the chance to catch up. And for Intel, we all know AMD is miles ahead when it comes to computer chips. And when it comes to my personal computers, I refuse to get an Intel chip in it because I know AMD chips perform better and it's priced better. Not only that, Apple's own M-chip series are head over shoulders better than Intel at the same price point. And love it or hate it, that's the story with big tech. In order to stay relevant, you have to continuously innovate like Google or Nvidia. Otherwise, someone else in Silicon Valley will overthrow you. You cannot become complacent or satisfied in big tech. For instance, let's talk about Cisco's WebEx, right? It's basically their version of Zoom, where you're allowed to do video conferencing calls. And if you have ever used WebEx before, then you know that it's just not good. I've only used WebEx twice in my life, and I did not like both circumstances or how glitchy the platform was. One was for my interviews with Cisco, and number two is when I interviewed with Gartner, the consulting firm. Almost everyone prefers Zoom over WebEx. And not only that, both of the companies that I work for, we just used Microsoft Teams. Because not only is there a chat function that's just good, but also there's a video function to Microsoft Teams. Cisco is also losing ground in their biggest sector. So when we think about enterprise networking, which is their bread and butter, it's losing market share to Juniper thanks to their product Mist. And as far as their data centers go, they're losing clients because of the cloud and thanks to Arista networks. Not by a significant amount, but it's slowly happening as Arista is preferred by a handful of networking IT engineers based on my research. The thing is, Cisco's technology and networking, it gets the job done. Just like I'm not an IT guy, and in the past, whenever I had to use it to log into my accounts, it worked. It did its job. But apparently, Cisco is inefficient, has less reliability, is buggy, and has less reliance on AI to run their operations, which I think those are all rooms for growth and opportunity. Which brings me to what you are seeing on your screen right now. On June the 4th, the leadership at Cisco gave their annual Investor Day presentation, and the leadership went on and on to make investors bullish about Cisco's future. And here's what I thought were important. Well, number one, the leadership team emphasized that Cisco is going to move to be more services focused with subscription revenues. I told you we would circle back to that topic, and as of right now, 24% of their revenue is sourced from services, but they want to see that number grow to at least half of their income source. The goal is to see their income 50% from services. The same story with Apple. It's no surprise that the market is oversaturated with Apple product. Everybody and their neighbor has an iPhone, a MacBook, and even an Apple Watch. As such, Apple sales are not growing as fast since everyone already has their products, which is what is happening with Cisco. Cisco has basically already pitched their sales team to every available company in the US. So what do? Well, Apple's solution was to grow their revenue through services and Apple Care, because Apple's leadership team quickly realized that not everyone wants to spend $1,000 a year to upgrade to a new iPhone. However, people are willing to spend money to replace their battery so that it can go from like that 89% battery health back up to 100%, or to get their screens fixed when they dropped it in the toilet. And guess what? It's working out for Apple. And speaking of which, Apple also announced their AI ambitions, and their stock price just exploded very recently. So with that said, I am very pleased to say that Cisco also announced their AI partnership with NVIDIA, what you see on your screen right here. And if you know anything about NVIDIA, then you know that NVIDIA is the cool kid on the block when it comes to the AI movement. But the price of Cisco stock, after they announced it, well, it stayed relatively flat because of the guidance for this year was not bullish. So what you see on your screen right now on the right side, they're estimating $53.7 billion, whereas last year it was higher, so it's going to be a decrease. Investors did not want to hear that. I think it's good that the leadership team were transparent and honest about their expectations, but it just shows you that Cisco is struggling to grow their top line, and I think that's why the Splunk acquisition had to happen. Cisco's leadership team also threw the word AI around every 5 minutes or so. Actually, it was closer to like every 2 minutes. So at least they understand the assignment and know that they need to pump money into AI to stay relevant. And Cisco is putting their money where their mouth is. Cisco has created a small Shark Tank type of incubator for small AI startups that need funds to stay afloat. So they're allocating $1 billion into AI startups for them to buy them out or to hold majority stakes in these small startups, so that when their valuation goes from like, I don't know, $50 million up to $2 billion, well, that's going to go on Cisco's balance sheet. And I think this is the correct move and is proof that Cisco is trying to stay relevant for the future. They're being proactive instead of reactive like Intel. It's like the Google innovation method. I don't know if you know this or not, but every single year or two, Google launches about 20 new projects to see if any of them will be successful. They don't even know, they just gamble. And if the project turns out to be a dud, they do not hesitate to pull the plug. But all it takes is for one Google project to hit it big for their investments to get a wonderful ROI. And I think this is a playbook that Cisco is following that I think is successful and very smart, because even Amazon does the same thing. Hopefully this can work out for Cisco. And so far, Cisco has invested $200 million into the startups Cohere, Mistral AI, and Scale AI. So in my opinion, I think their future game plan is logically sound, but execution and no further headwinds will be crucial for them to be successful. If they keep giving lower and lower guidances, I can't see their stock price doing too good. Any slip up or mistake, and I think their stock price is going to go tumbling like Intel. With that said, it brings us to my most favorite part of the video. Now I am going to run some valuation models to figure out what the intrinsic value for Cisco should be. So they're currently trading for about $45 to $46 a share, but I want to know what is their intrinsic value to figure out if they're undervalued or overvalued. And once we do that, we're going to compare it to what the Wall Street analysts believe their price target should be. And then at the very end, I'm going to give my full opinion on Cisco and what I am going to do. And since we have like, I don't know, 10 more slides or so, we'll circle back to these slides later when I give that commentary. Alrighty, folks. So the first intrinsic valuation model is going to be the multiples valuation. Essentially, we're going to figure out a market-derived perceived price based on the PE ratios of their industry peers. So with that said, their multiples valuation is $137.18 a share. The next one is going to be the discounted cash flow analysis model. Basically, their free cash flow and the growth thereof is going to tell us an intrinsic value for Cisco. And that's going to be $91.97 for their DCF intrinsic valuation. The next one is going to be the dividend discount model valuation. Essentially, their dividend payment and growth rate is going to tell us the intrinsic value for Cisco. So their DDM price, $31.13. The last one is going to be the Benny Graham's valuation model. Essentially, their growth rate projection and the corporate bonds yield rate is going to tell us how much Cisco is worth. And that's going to be $28.27 a share, which brings us to the conclusion. Now we're going to figure out if Cisco is delicious or disgusting based on what we see here. Now, when we take all of these intrinsic valuations into consideration, well, the average valuation for Cisco is going to be $72.14 a share. Let's go ahead and see what the Wall Street analysts believe the price for Cisco should be. So based on all of these different analysts representing Wells Fargo, JP Morgan Chase, Bank of America, Citigroup, well, they believe that the price for Cisco is $56, which is a 23% upside to their current trading price of $45. The low forecast is $50, and the high forecast for Cisco is $76. And because we said around $72, we are near that high forecast region. So based on our calculations, we said $72, Wall Street says $56. Nonetheless, because Cisco is currently trading for about $45 to $46 a share, and the low forecast for Wall Street was $50, by all accounts, Cisco is undervalued. So now that we understand the intrinsic value for Cisco, now I'm going to try to figure out an acceptable buy price. Based on everything that I've heard so far, now I just want to know, do the numbers make sense? I'm just going to round up and say it's $46 a share. With a 10% margin of safety baked into this intrinsic valuation, then the acceptable buy price is $64 a share. And if I were to buy Cisco at its current trading price, well, then I would get a discount of $18.92 a share under the assumption that I'm getting a 10% discount. However, if I were to say, I don't know, like a 15% margin of safety baked in, with a 15% margin of safety baked in, then my acceptable buy price is $61 a share. And if I were to buy Cisco at its current trading price of about $46 a share, well, then the margin of safety that I get is 36% from its intrinsic valuation. But I want to play it safe and I want to be conservative. So I'm going to go ahead and plug in what the Wall Street analysts believe the price target for Cisco should be, because they concluded that it's worth $56, which is a lot smaller than what we said. And so under the assumption that Cisco is only worth $56 a share, with a 10% margin of safety baked in, then the acceptable buy price is $50.40 a share, which still says that right now Cisco is undervalued. All right, so what are my thoughts? And full disclosure, I am losing my voice because I've been filming now for an hour and a half straight. But anyways, to be fully transparent, I think I like the company based on all the intangibles, reading through their investment reports, and learning about their future forecasts. I think I like the company. So as I am contemplating whether or not I want to buy into Cisco, I'm reminding myself that I'm not just looking at them as just a stock. I'm thinking of this as an opportunity to buy into a company that makes me a part owner of a real business operation. And I have to ask myself, do I feel fuzzy and comfortable with the idea of buying into Cisco and being an owner? My answer is yes, absolutely. Is it going to have returns like NVIDIA? Most likely not. I am realistic about this investment. Cisco is an old tech company like Microsoft. And when I think about Microsoft, they also went through a long stretch where their stock looked like Cisco's. In fact, from the year 2000 to about 2016, Microsoft was flat. I am not kidding. An investment into Microsoft in the year 2000 would have taken you 16 years to break even. So an investment into Microsoft was like poking a pile of poop with a stick to get it to turn into anything but poop. But as we all know, Microsoft had a comeback story and they rebounded, right? Microsoft was able to create a subscription model business from their Office products, capitalize on their Azure cloud, and they made strategic efforts into online gaming. And as a result, their stock price has just exploded for the past 5 to 6 years. And of course, how could we forget? Microsoft also started to invest into and become part owners of ChatGPT and the whole AI movement. Anyone who is not investing into AI right now is going to be left behind. So when I think about Microsoft, they have just been making the right moves again and again since the pandemic. So what I'm trying to say is Microsoft used to be known as a boring, dry tech stock and a company. And I think right now, Cisco is known as a boring and dry tech stock, but they're just one correct acquisition away to exploding like Microsoft, in my personal opinion. Because as we go forward, I think cybersecurity is going to be just that much more important and relevant. And that's a line of business that Cisco is involved in. But who knows? It really depends on which company that Cisco is going to acquire next. So I guess by investing into Cisco now, I can say that I'm just early. I don't know what they're going to do next. I don't know what their next move is. But all I know is that once they make the correct acquisition, it's going to be too late. Or I could be absolutely wrong and Cisco just goes bankrupt. But as of right now, I don't see Cisco as a terrible place to park some of my cash to yield about 3.5% a year in dividends with a CAGR of about 9% a year, as we saw in the earlier example when we factor in the share buybacks and their slow growth rate. And I get it, it's not the best returns, but that's the cynical bearish outlook, getting a rate of return of about 7 to 9% a year from Cisco. However, in a perfect world, of course, I would love to see Cisco make a comeback like the boomer tech stocks IBM and Microsoft did, right? Both of them are also as old as Cisco, but their stocks have just exploded. So if IBM and Microsoft can do it, it gives me hope that perhaps Cisco can pull it off as well. But that's a big if. We don't know if Cisco will be able to figure it out. But as of right now, I am taking my chances on Cisco, and I'll continue to dollar cost average into Cisco as they trade for around $45 a share. And if they dip below $40, for me, that's an absolute steal. But please, I beg of you, please do your own due diligence and research to figure out if you like Cisco. Don't just take my word for it, because my conclusion is that Cisco is undervalued and I'm going to buy into it. I think it's okay. I'm not saying that it's the greatest investment, but that's just what I think. You might do your own research and find out that, hey, Cisco is a dumpster fire. It's terrible. It's a waste of money. And if you reach that conclusion, more power to you. I'm not telling you what's right or wrong. Everybody has a different opinion, and my opinion is that I like Cisco. So with that said, if you enjoyed this video, please do click the like, as it does help me out. And if you choose not to, that's okay. I'll talk to you next time. Stay safe.